Say hello. My name is Julie Ann Peterson, and I'm with Old Capital Lending, and I welcome you to tonight's Zoom at 8. We are excited that you're here and wanted to connect all of the new folks. I know, Cody, have you been with us before?
Yeah. I took a little hiatus. I was out of the country for a little bit. Went to Rio de Janeiro for a couple weeks, and so now I'm back.
Okay. So you've recently had something that you've been working on.
No, I wish.
No? Okay.
Not yet. I mean, it's definitely something that's on the radar, and I could use a little bit more of some action.
Where are you located, Cody?
Grand Rapids. I remember we discussed you had
Oh,
some kids in
that's
Kalamazoo,
right.
right?
Yeah, that's right. Because we just canceled our trip there.
Yeah.
We were supposed to be coming in April, so we're a little bummed about that.
Yeah, I bet. Sorry to hear that.
Yeah. So yeah. Who else is on here? Let's see. I can't see who else is on. Cody, but so probably yeah, it's only the four of us today. Wow, that's crazy. All right. Wanted to start out with saying hello to everybody, obviously, and then kind of want to go over what's going on in the market. We just had another increase in interest rates. So we had a decrease about 70 basis points about 6 weeks ago, and we've been slowly getting increases. So last week, I think we raised it 25 bips, and then we just had another 15 today. Tuesday, yes. So we're going up, even though the market's showing that the single family residents are below zero or at zero. We're not seeing that in the commercial loan families. So keeping that in mind, while interest rates are completely low, 4.5% to 5% compared to what we've seen for the last couple of years, more so like 4.5%, 5%. With these lower rates, you're going to get higher leverage. So 75 to 80% when maybe you have seen 70 to 80, 70 to 75 rather, based on debt service coverage. So great opportunities to be purchasing properties. However, there is a lot of unknown. What's going to happen over the next 2, 5, 6 weeks that can trail out into July, August. So there's a lot of uncertainty. I actually just got some information from a deal sponsor that I have and an LP on, and just setting the stage. So if any of you guys are in LPs in any of the deals, I would be reaching out, or hopefully your deal sponsors or your GP is setting the stage for you, setting the expectations, because as the workforce cannot be, paying their bills, rents, their monthly stipends are going to be cut, and therefore rents are probably not going to be paid, or they're going to be reduced collections. So make sure that you're getting that information back from your GPs. But if you're also underwriting using the SDA, please take into big consideration that we need to be inflating a lot of the reserves, getting your occupancies dropping, make sure that maybe you're not looking at maybe your 5 to 7, but maybe you're 10 to 12 on the occupancies. We're also going to be looking at how this is going to be impacting your pro formas, what you thought you were going to be able to get done for year 1. Now we're seeing it probably going to be pushing out to 2, 3. Okay, so just be really thinking about this when we're doing your SDAs and inputting a lot of this. And when we're going to buy, these are things that we're also going to be looking at the values. If we've got reduced rents and occupancies, some of these values that are being put out there, you're going to need to really scrub them. And sellers are really going to need to be thinking about, who's really going to be able to take this down. Maybe they're only going to be getting 2 offers as opposed to the 20 offers. In that, the time frame for closing, typically we've been at 45 to 60 days. And now we're going to probably see that pushed out 60 to more like 75. So make sure you're putting in your due diligence, extending that time, whether it's because you're having a hard time getting the appraisers out, the engineers out, the travel is going to be, we're going to lengthen that time to get people on at the property. If we've got still this coronavirus sitting out in some of these tenants, to get them to move out, and by that, and I'm not saying move out permanently, but rather take a couple half an hour to get out of your unit while you're doing your appraisal. All of this is going to slow up. People are not going to be home, they're going to be more home, so things are going to take time. So make sure that you're putting in clauses to your due diligence and on your offers to make sure that you can deliver what you've committed to. What else? I think also when you're talking to your investors, making sure that they know, what we were seeing before was 15% returns, and those are going to be condensed. We're not necessarily going to be seeing the 8 and 10s, but maybe only more like 6s. So take the temperature of your investors. Maybe they're only going to be investing 50 when they used to think they were going to be investing 100,000. Maybe their temperature is that they're just not sure. So I would make sure that you're learning and keeping track of your investors, because that's obviously going to lengthen your capital raising power as well. So all things to be considering when we're going it forward in the next 2 to 3 months. We just don't know. All right, so that's all I have for the market. Is there anybody that's working on something currently that needs a little bit of feedback or has some questions or would like to just visit on something? Time is now. Anybody?
I actually have a question.
Yeah.
So we're actually, hi, yeah. First time here, but
good.
We're actually touring a portfolio of 5 properties for 28 units tomorrow. And you talked about some of the risks and conservative underwriting, but I'm curious if you know anything about opportunity zones or historic districts, because I think I'll have to double check it, but I think all 5 properties are going to be in an opportunity zone and historic district. So I didn't know if you had any advice there or recommendations.
I think there's great opportunity in opportunity zones. We're seeing some better rates on loans. I'm in an opportunity zone. For investors, it's great for 1031, and Nathan will probably be talking to us about that tonight. But I can visit with you more on it if I understand the deal. Does anyone else have anything to share about the opportunity zone? No? Nathan, you'll know though. You'll have some information.
I can mention some stuff. I mean,
okay.
As I kind of go through my presentation. So, yeah.
Okay, cool. So Stuart, keeping in mind those properties, are they contiguous? Are they close by? 3 miles from each other?
Yes, I know. I don't have the addresses of all of them yet, but I know 2 of them are like adjacent.
Okay.
So I think they're all pretty close, and the seller is he's actually a guy who won a spot in office, so he was running for politics and got a spot and he's looking to have less to manage. So
Oh, there you go. Yeah, I think you're going to find a lot of folks have gotten into this space and, you know, without a lot of experience. And so there is the uncertainty of all of this is going to have great opportunities for all of us who have been doing this for a while. Stuart, I've got a person who is like I say, I've invested in one in an opportunity zone, although he built a property in an opportunity zone, but to get more clarity on maybe what you can do for your investors in terms of returns might be helpful. And I can push that person over to you to speak with them.
yeah, I had done some research, but hadn't figured out everything yet. Like I heard that if you put X amount dollars into the loan or whatever, then you have to put that much into renovations to be able to get the tax benefits. But I just wasn't sure on some of the different things. And then did you have any recommendations, since it's going to be, it's like a quadplex 5, 6, 6, and 7. So is there any difference when underwriting those, since it's kind of spread out just a little bit, or is it all kind of the same underwriting in the syndicated deal analyzer?
I would analyze the whole thing as one.
Okay.
So 28 units.
Okay.
Because ultimately you're going to get one loan from how I'm thinking of it as one loan. I mean, it's going to be much more expensive to take out 4 loans for that, or 5 loans, however many it takes. So unless you can go to a bank, they might be able to put something together for you, but you're not going to get the same kind of terms as you would like on a non-recourse agency debt loan.
Yeah, we're figuring all that out, I guess, tomorrow. This is our first, we just got started kind of researching January 1st. And so this is our first real action step here. So
how fabulous. That's great. Well, keep us posted. We'll be interested to hear.
So I have a question.
Yeah, Kavita, hello.
Hi, how are you?
I'm good, thanks.
So is this like, do we have to, when we go to the investor, we have to assign the funds separately for the opportunity zone? There is separate funds?
I am not an expert on that. I cannot speak to it. Nathan, do you know anything about that? You got to unmute
Could you
yourself.
repeat that last sentence, please?
So for opportunity zone, do we have to open a different account for the funding? And is there a different process to get the loans and everything?
And in terms of from a 1031 standpoint, I can't tell you that. I'm not an opportunity zone specialist, so I couldn't tell you.
It's not 1031, but if any deal comes up, so how does it go? Because it's different from the regular deals. That's what I have seen.
Yeah, I would say on opportunity zone, I would say that there's nobody on the Slack tonight that would be able to be an advisor on that. So I would want to put you in touch with somebody who could advise you better than any of us on here.
Yeah, that would be great. Yeah.
Yeah. Let's take that offline. So.
Okay. Sounds good.
All right. So you guys, I do want to introduce our speaker for tonight. It's Nathan Webb. He deals in 1031 exchanges, and if you're familiar with 1031s, then great. Maybe there's an opportunity for you to jump in and explain and maybe share your experience. Or if you have investors who have properties like myself who need to jump into a deal or who want to jump into a deal, so that you can be the expert or put your client in touch with Nathan so he can put, you guys can put each other together to help him understand how your investor can jump on your deal. So that's why I thought I would bring tonight Nathan Webb to talk to us about 1031 exchanges. So.
Great to be here, guys. Thanks for having me.
Yes, for sure. You're on. So you got about 30 minutes.
All right, I can share my screen.
Yeah.
Let's share that. And I'll get started here. All right, so 1031 exchanges. This is real estate's greatest wealth building and preservation tool. Something I really just want to share with you guys tonight. So a little bit about me really quick is that I'm a qualified intermediary for 1031 exchange. On top of that, I'm a real estate professional. I've done acquisitions for a firm here in Los Angeles for a couple of years, all multifamily. I look at multifamily all the time. I deal with transactions all the time for 1031 exchanges. So that basically makes you a professional, right? It's a very broad term. I'm full-time in real estate as an exchange accommodator, real estate investor, and I'm licensed in the state of California. So when it comes to doing 1031 exchanges or questions about how does that work with apartment buildings, I'm your guy. So that's one reason that I'm here tonight, is not just for the 1031 exchange, but to get a little more specific on what that looks like in the investment world and in the multifamily world. A little bit more about my company, American Accommodators. We're 100% independent. We're 100% electronic. We're actually a fintech company. We're not a pen and paper company. And we, because of that, we have $100 million in FDIC insurance per transaction. And we've been doing exchanges for 20 years. Not me personally, but my team. And when you use me, you get access to my team, which is lawyers, CES, and all those other exchange specialists that come with a 1031 exchange. So you get a team, you don't get an individual. And our website's aa1031.com. But enough about me. You guys came here to hear about 1031 exchanges, right? So many of you probably know what they are. But if you don't, well, let's just dive really deep into it. First thing, right? U.S. Code Title 26 subtitle. No, we're not going to talk about this. There's way too much information. This is ridiculous. You've got all this tax code and stuff you got to worry about, and you don't need to worry about that. You don't need to read this. This is what I have to deal with, okay? So I'm going to break it down for you. I'm going to make it real easy, and we'll talk about like what makes a success, how you can leverage it to your advantage, etc. Okay? So what it really is this is a method for 100% deferral of real estate related taxes, which is federal capital gains, state capital gains, depreciation recapture, and Medicare taxes. You might have just thought, hey, I got that 20% capital gains tax I got to pay. Not in California. You're going to double that with their state taxes pretty much. Oh, and if you've done depreciation correctly, or if you've done a cost seg study, then you've fully depreciated your asset. You've got to pay 25% of that back in taxes as depreciation recapture. And if you've been have a valuable enough asset, they're going to tag you for Medicare tax too. So there's a lot of taxes involved in the dealing of real estate, and the 1031 defers all of those. Would you have to pay them in the future? Yes, if you sold, but you can continually defer. So this is deferral, not forgiveness, right? Unless you go to an opportunity zone or do some other things. So there's some tricks in there we'll talk about. But disclaimer, I am not your tax accountant. I'm not your tax advisor. I'm not your tax professional. I'm a 1031 exchange accommodator. So disclaimer, go talk to your tax professional and find out from them if they think that you should do a 1031 exchange or not. I'm not going to advise that. I'm going to say always do one, because they're so dang cheap to do, and you never know where you're going to get your taxes, because it's related to your income when it comes to paying capital gains and deferring taxes. So talk to your tax professional before performing a 1031 exchange. Real quick, so always be thinking the 3 T's of a 1031 exchange. That's taxes, title, and time. Taxes, title, and time. Those are always going to be a factor. And we already talked about taxes a little bit. This is a tax deferred exchange, so taxes are involved. Be considering those every time you may want to sell a property, okay? But what does that actually mean? Well, a 1031 exchange has to do with capital gains taxes, and it can only be if their property has registered income. So if your property is producing income, then it's been paying taxes, right? Which that's a qualification. The other one is, who's on title for that property? Have they actually been holding it for a set amount of time? Who is on title, and is it you as a person? Is it an LLC? Some of you may have bought a property under your own name. and you switched it to an LLC or you grant deeded it to someone else, whatever you may have done, that title does come into play as well as with the time. And it's kind of like a 2-year standard for holding. So if you've held a property for 2 years, it's been the same title, you've been paying tax on it for at least one tax season, which is over a year. Better than that is 2. Pretty much you're qualified for a 1031 exchange at that point. But again, talk to your real estate, your tax professional. Okay. There are types of exchanges: forward, reverse, build to suit exchanges, or construction exchanges. A forward is what 99% of the exchanges that I do. They're real simple. They're cheaper to perform because you sell a property, and it doesn't require a title holder. You get 45 days to identify and 180 days to close. This is what we're going to be talking about for the majority of our time here. Is you're going to be thinking about a forward exchange. You also have a reverse exchange, which is the opposite, which is basically you identify a property first, you get it under contract, but you need time to sell some property in order to put the value of that property into that replacement property, the property that you're buying. That requires a title holder to come into place, or we call it EAT, right? An exchange accommodator title holder. That exchange accommodator title holder comes into play on a build to suit or construction exchange. But basically you can kind of treat it like a forward exchange, but use your exchange funds as a way to make improvements to the property, to get it to the value that you need to make it a successful exchange. Okay. So just be aware, those are some different kind of exchanges out there. Mostly we're going to be talking about forward exchanges or deferred exchange. Basic exchange. This is what a lot of people don't understand what kind of my role is. Hey, I want to do an exchange. When does that need to happen? And basically it needs to happen when you're in escrow, not before, not after. If the property is closed, I can't help you as a qualified intermediary. You need to assign the sale proceeds to a QI. You need to say that you're doing a 1031 exchange. You need to sign all of that documentation and put me in place before you close escrow on your, what we call relinquished property. So whatever you're selling, right? As soon as that property closes sale, the escrow officer, whoever's handling your close of sale, those proceeds go directly into your account that is held with us. So we're a glorified money holder, and you use those 45 days to identify the property or properties that you want to exchange into. You fill out the documentation for that, and then you tell me when and where you need to direct those funds to the replacement property to the escrow officer. So I deal with kind of you directing me where to go with your exchange funds, and then I put them in place with the right property, with the right documentation and the right escrow officer so that we can perform a successful exchange. So that's your basic forward 1031 deferred tax exchange, okay? That is not how reverse works, obviously, but if you want to do a reverse or you want to talk about that, we can talk about that another time because it's a more complicated process, requires consultation. This is, like I said, 99% of exchanges happen exactly like this, okay? Are there any questions that anyone has thus far on these few simple procedures, preliminary things?
I have a question.
Was that someone had a question?
Yeah, I have a question.
Go
ahead. When should one start planning for a 1031 exchange? In essence, how far ahead should I consider a 1031 exchange while I'm holding a property? Should I wait till I actually go to sell and then start, or should the planning process take place a year, 2 years, or like how soon should, if I'm planning to do a 1031 exchange, should I start talking to my GPs, the fellow, my investor partners and things of that nature in order to get them ready?
Okay, so we're probably talking about an apartment building, right?
Yes.
Okay, so that gets a little more complicated. I'll tell you about that when we get kind of to that point. I'm sure there'll be a lot more questions. So that's a great question. Love to answer that. Let's get through some more basics first, and then we'll get down to the nitty gritty. Cool?
Yep.
All right. Anything else basic? Let's
I
cover
just
some more
had a
basics.
question, Nathan, I had
Yeah.
a question. I know we're not dealing with the reverse, but on the reverse, when you identify first the property that you want, is it 45 days or 180 days that you have to close on your property? Is that what I read?
It's 180 days to sell whatever property you may need to go into that replacement property. So you've basically already identified, you've already bought, quote unquote, bought the property. You put someone like me in place, so I hold the title for you. I'm kind of on the line for the money, and then I've looked at the property that you have, and so I'm saying, yes, the value matches what we need to be able to do to get into this property. Let's set that whole thing up, and then you can have 180 days to sell your property.
Okay.
So you don't have to worry about the identification, you still have to worry about the sale, but that's kind of how it takes place. So I have a really interesting scenario that we'll cover near the end that kind of shows that as an example and why you might want to do that.
So you put the cart before the horse on that.
Yeah,
one.
I like the cart before the horse. I like that idea.
That's what I'm thinking. You got to do that.
Yeah.
You're looking at a difference of several $1,000s to perform the exchange, though, because there's a lot more liability on us in holding your property as a title holder, et cetera. So it is a great idea. Most people who find the property they want don't even need to set up an exchange because they've worked out with who they're buying from. Like, hey, I just need to do an exchange, and then they sell their property. And basically, I just perform a forward exchange or a simultaneous exchange. As soon as you sell your property, you know, and you already have this one under contract, I can transfer the funds directly into the replacement property, and it can be same day.
I would think that there is some concern if you were to, for instance, sell a duplex and go into a syndication. Would that also work if you had a TIC opportunity? That gets a little hairy, doesn't it?
That, like I said, that's exactly kind of what starts happening when you get into a reverse exchange, as well as you're adding hair on top of hair in that sense. So it comes down to a consultation. So if that's something you're interested in, we bring in our legal team and we can say, like, well, what do you have? What do you want to do? How is this all going to work out? And go from there.
Okay.
Yeah, because I would think the structure has to be different with it. You have to have a TIC involved.
Yeah, I'll talk about the structure here in a little bit. It's what we'll probably spend most of our time on.
Okay.
So let's go ahead and go forward and kind of get through some of this stuff, and then we can really dive deep. Okay.
Okay.
So a lot of people say, well, what is exchangeable? According to the tax code, it's real property, so it has title, right? We talked about title as one of the 3 T's. Like kind, that's a very broad and general meaning, but it's basically if you can prove that it's intended for investment or productive use, then it qualifies. So if you have, it can be a single family home, it can be a condo, but as long as you've been reporting that income, right, it's not your primary residence, it can be used for a 1031 exchange. And then that means you can go into an apartment building, you can go into a warehouse, a factory, you can go into multiple other properties, you can go into raw land, you can go into oil and gas royalties, because even though it's the mineral rights, you're still buying the land, what's underneath the land. So that works. And you can buy, and you can even put it into trusts, certain trusts that are backed by property. So as long as it's real property, like kind, intended for investment or productive use, you're pretty much good to go. All right. So where most people get hung up are on these kind of rules that I'm just going to cover really quick, because I want you to be successful. I want you to make sure you hit that target when you're doing an exchange. When I say you have 45 days to identify, what does that mean? It actually means you get 3 options. Initially, you get 3 options, and you may only want to go and sell one property and go into another property, but you can use those other 2 identification options as just options. Just like, well, maybe I don't close on the first property, but I can close on the second property, or I can close on the third. Or maybe you had 2 properties in mind, but you just want to have, kind of a third safety option in there. And those lines are there for that reason. Most people want to put several options in there, because if you don't close on one, then, you got other options there to close on when you get to your 180-day mark. You know, you can, 45 days happens pretty quick. 180 days is a long time sometimes. So you have those other options available, okay? Some people want to take out money from their exchange for personal use. They need to pay off some credit cards or debts or all these other things, and that's called boot. Boot is really just money that doesn't meet the exchange requirements or has been designated to take out and not go into an exchange. A successful 100% deferred tax exchange means all of your money goes into the property. So you're selling a property, it goes 100% of that money goes into the next property, 100% of your taxes are deferred. The only rule you've got to worry about there is that as long as your replacement property, the property you're buying, has a value greater than or equal to your replacement property, your relinquished property, so the property you're selling. So if you have a duplex you're selling for $500,000, as long as you're replacing the property you're buying or the combination of properties that you're buying is $500,000 or more, you're good to go, right? If you don't purchase a property that, you know, let's say you sold for $500,000 and you're buying a property for $400,000, what are you going to do with the $100,000? Well, if you don't find something to put it into, then that gets counted as boot, and boot is taxed. The IRS will tax it, okay? And since your deferred taxes are based upon the appreciation of the property, you definitely don't want to make sure that that boot is the amount of appreciation that you've seen in your property, because then you're just going to get taxed anyway. So we don't want that to happen. I always recommend that people, if they need cash for any reason, you do a full exchange into the property and then refinance it. I don't care if you do it the very next day, but once you refinance it, you can pull however much equity you need out of that as cash, put it on the loan, and then go buy another property or do whatever else you want, okay? So there are other options out there besides boot, but you do need to know what boot is, just in case. And then a very rare rule that comes up is the 295 rule, which is basically you want to purchase more than 3 properties. You want to do 4. And maybe you thought, hey, this will be a great way. I'll just identify like 100 things. And then I only have to choose 1 at the end of the day. Well, the IRS said, no, we're not going to let you do that. So if you identify 4 or more properties, then you have to close on 95% of them. That's where the 95 comes from. And the value of those properties cannot exceed 2 times or 200% of what you sold for. So if you sold for $1 million, you can only buy $2 million worth of property. So you don't get maximum leverage that way, but if you really wanted to like diversify your portfolio or something, there's an option there for you, just so you guys know, okay? So those are just some quick and speedy rules for being a little more successful in your exchange, and I'll give examples of those later on, okay? But why do you want to perform a 1031 exchange? I mean, there could be a lot of different reasons, and one of the great ones is really you just get more buying power, okay? 100% of tax deferral means that you can stretch, leverage yourself a little more, buy more property, buy bigger property. And I'm going to do a quick, just kind of a quick math problem for you guys, run some numbers. You guys are used to that, right? You guys use the SDA. So you guys are used to numbers, but this will be real basic for you guys, okay? There's a lot of other reasons why you might exchange, very personal reasons that we can cover more of, but the real one is that tax deferral. It's the whole reason it's there. It's for you to grow wealthy and keep your money. So following example, this is based on so if you're looking over here on the federal long-term capital gains tax in the state, this is for California. This 15% and this 9.3% is going to be based off of your income. And you get to these percentages very, very quickly in California. So, I mean, if you have a steady job, you're going to be paying this in taxes on any property that you might have. So quick example, we put $25,000 into a property that was $100,000. 25% is going to be a rule here. So we've seen it appreciate 25%, which is not unheard of, right? And so our capital gains for that, our appreciation is $25,000. So that's what we would be taxed on. Now, I'm also not taking into account depreciation recapture or Medicare tax because I'm not your accountant, I'm not your CPA. I haven't been doing your depreciation for you. I'm not telling you how long you have held this or haven't held this, just real basic example. So if you sell, you're going to be paying about $6,000 in taxes. So while you could take all that money and reinvest it, you might be strapped for coming up with that cash later down the road when your taxes come due. So, you know, you can just take all that money out and try to put it into another property right away, but the tax man's going to come calling and you're going to owe. And in the state of California, actually, they make me, your qualified intermediary, hold some of your taxes for you. If you go into an exchange and take out boot or anything like that. So just be aware that there are other states out there that are going to make sure they get their taxes first, right? But you got to pay the tax man. So you basically, though, have, if you're going to pay your taxes, you have, you know, $43,925 in cash after you pay your taxes, and it would probably be less than that because you probably pay more taxes. But that at 75% loan to value, your purchasing power is $175,000, right? Whereas if you're doing an exchange and my exchange fees are $750, I even put that in there for your convenience, you know, you've got a lot more money to go forward into your funds, into your purchase price. So you can buy almost up to $200,000 in purchase price at 75% LTV. So you're leaving over $21,000 on the table in purchasing power that you didn't normally have. And while that may not seem like much in this case, let's just run it out like 5 more iterations, right? So same LTV, same appreciation rate, same tax rate, which would actually be way higher the more you got. But if you do the same thing, paying your taxes up front, not doing a 1031 exchange and getting to 4 or 5 properties later, stretching it to 75% loan to value every time, look at what your purchasing power becomes by that 5th iteration, right? Do you see the difference that's there? It's huge. Now imagine, okay, well, I bought, you know, we're at iteration number 5 here. I'm buying a $1.6 million property, you know, versus a $3 million property. What's the cash flow difference on those? So you may have all your taxes deferred and you may owe at the end of the day, but how much more cash flow are you getting on a $3 million property than you are 1.6? So don't forget that.
I'm sorry.
Oh,
Nate,
and also, you know what? You could change title, grant this into a living trust if you've got kids, and you can pass on all these capital gains that you're going to have to pay. Well, if you pass away and pass it on to your kids via living trust, your basis goes back to 0. Your taxes don't follow you to the grave. So that death and taxes thing, well, actually, you can avoid taxes. So it is a possibility. There's other ways you can do that too. You know, opportunity zones is one of them. Living trust is one of them. So there's ways to kind of do that. But just see the power of a 1031 exchange, and that's why you'll hear me say, swap till you drop. Also, if you're fully depreciating an asset over like a 5-year term, imagine what 25% depreciation recapture is going to add to all of this, and how much harder that's going to be. Okay, that you're going to have to pay more taxes on that too. So this is a very mild case of what you'd be paying in taxes. But just you see the multiplicative, the snowball effect, you know. So
I was wondering, Julie, if you could.
Yeah, I'll answer questions. Go ahead.
No, it's not really a question. I'm just I can't really see your slides. The video, the faces are kind of covering like a third of my screen, so I can't really see the
So
slide.
you don't see the whole screen?
No, it cuts off right after number 4 because of the faces, like in the vertical line.
Let's see.
So if you can actually, that's your screen. So if you can click and drag, you can move those faces to any side of the screen you need to.
Okay. All right.
I guess you drag it.
Yeah, click at the top and drag.
Oh, okay. Yeah. All right. But yeah, where do I drag it to?
You can also hit the minimize
Oh, okay.
button.
I can put it down at the bottom. Yeah, that's fine now. Yeah. Thank you.
Perfect.
Cool.
Yeah. Sorry about the interruption.
No problem.
So Does anyone have questions about that before we jump into like apartment stuff, Reg D, TIC, DST stuff? I can go back.
I just had a question, Nathan. I wanted to go back. You had talked about the title. I had put our duplex in my husband and my name. Then we opened up an LLC. I went back and tried and talked to some people, and they said, do not change the title to LLC because that's not how you took it out. And your bank could come knocking in and call the loan. So I did not change the title on it. Does it matter? Because I'm going into the next one. Will I need to put it in an LLC, or does that not necessarily matter?
So you're in an interesting place. So it depends where your property is, where you're exchanging into, and if it is just you and your husband, and the LLC is just you and your husband, we have this interesting thing called common property law in California. It's also in Texas. So it will depend on where you're exchanging into and out of and stuff like that. But basically how the IRS is going to look at it is whether it's in your name or it's in an LLC that both of you own, they're going to look at that as both of you owning it.
Okay.
So you should be okay. But if you want to, I don't know what the bank is going to say, whoever's holding the loan on that. But I think you're fine leaving it as it is and doing an exchange, or changing that into an LLC. And you can change it after you exchange too. So we can just go through the exchange, go into your next property, and then if it's in a place with common law common property law, then you should be fine. You can change it almost immediately, grant it to your LLC basically, and you should be okay according to the IRS.
Okay, thank you.
You could also wait the standard 2 years if it's not in a common property law state, and then grant it to your LLC, and you should still be okay from an IRS perspective. Yeah, but from the state and what the loan and bank want to do are different things.
Okay, thank you.
Cool. Now the fun stuff, right? So everyone here is like, hey, syndications, we got partnerships going on. What do we have? And everybody's heard about a TIC. The reason you have to have a TIC is because you have to have title, right? Who owns title in a syndication, whether it's a 506B or C or whatever? Do you know who owns title?
The entity.
The LLC, the syndication LLC, right? So they're on title. So how can I bring someone with 1031 money into my syndication? You can't physically, because that syndication owns personal shares. It does not own, you can't sell off those shares as real property. And that's what someone needs to exchange into a property with you. So what do? You have to set up a tenant in common proposal with that property, and then you can basically sell off pieces of that property that the LLC owns, right? And then you can grant it to however that person is exchanging. So kind of like in our pie example here, you have Bob, who's a single unmarried man. That's what his name is on title. He's bringing in a certain amount of money via 1031 funds, and so you want to accommodate him because, hey, he's going to be a big investor. He's going to bring in a big piece of the pie. So I'm going to set up a TIC because I also know that there's another guy who's selling his property and wants to go into this one. So you set up that TIC alongside your syndication, and basically your syndication can eat up as much of that pie as it needs to, but then alleviate some of that and give it off to anyone who might want to come in with 1031 exchange funds. Now, if you really want to do a TIC, know that the IRS has put in some special rulings on what that TIC needs to look like in order to be considered a safe harbor. They call it a safe harbor for a 1031 exchange. So one thing that I do for a lot of people, because I'm also in the apartment space, is if they need advisement and consultation on this, apart from the attorney, more from the 1031 side, and being able to kind of flip those numbers around and help people understand, I help make sure that everything is being met according to those IRS rulings in your TIC, in your 1031, and then explaining to your 1031 people how they can identify, even if they're not my client on a 1031 exchange, how they need to identify to be able to get into that property the correct way. So if you guys run into a situation, hey, we're doing a syndication, but man, like we're going to get like 50% of our funding from someone with 1031 money. What do I do about that? Just call me. I'll help you figure it out. Okay. So that's kind of Reg D, 506C and Bs, and tenants in common. You can do a full TIC, and that typically looks more like a JV. So instead of even starting a syndication LLC and having to go through the whole Reg D stuff, you can just start a TIC, and you can basically have like 5 people on title, choose one person as a sponsor. People come in with their 1031 money, you give them a certain percentage based on what they bring in, and everything gets split up, however that needs to be split up percentage-wise. And then maybe the sponsor collects a management fee or an acquisition fee or even a disposition fee. You can write that up however you want to. Okay, and so what you may hear about, I hear about this probably a lot more than you guys do, is what's called a DST, and this DST is called a Delaware Statutory Trust. Basically, it's a giant TIC that's wrapped up in securities, right? So the SEC has wrapped up a TIC in what's called a Delaware Statutory Trust, and that gives them a lot of, basically they bought like 50% of a property, and then they place people into that property 50% usually at whatever their debt to equity ratio is, so that everything's met. And then they promise them a return. Typically, it's lower than what you get in a typical syndication. Most are right around 5%. But the issue with that is that you also have to be accredited to get into a DST. So it shuts out a lot of people from getting into apartment buildings. So if you see a Delaware Statutory Trust, it's going to be a yield type property. So Class A, maybe a B, a triple net lease, something that is kind of one of those yield plays that you'd see maybe Grant Cardone doing. And then it's accredited investors only, and they're really set in how they manage it, how they open it, how they close it, what all their terms are, and then they wrap it up in a trust and sell it to 1031s. You can still buy into that with cash, obviously, but that's all run by broker dealers. You might see a few real estate professionals running Delaware Statutory Trust, but it's another type of syndication, okay, that is 1031 exchangeable.
That's more like for institutions, right? Like bigger deals and stuff.
They're
like
all
that,
institutional grade.
Yeah.
Usually they're going to throw you a free lunch. So if you hear someone talking about, hey, we're going to be talking about DSTs, go get some free food and wine and stuff like that. So it's steak dinner and all the wine you can drink kind of thing. So feel free to take advantage of that, but definitely accredited investors only, and institutional grade property.
Right.
Cool. Do you guys, I'm sure you're going to have a lot more questions about the syndication TIC stuff, but let's go into some examples just so you can see how we can get a lot of variety with a 1031 exchange. Okay. So Bob had a farm. Bob Industries LLC was meant for productive use. He reported income on the farm, is 1031 exchangeable. Sells the farm for $4 million. He's got 50% equity, so $2 million in cash, but he's got to buy $4 million worth of stuff. So he wants to buy a really nice house for himself. So he buys a single family home for $500,000. Oh, but that's a personal residence. He can't do that. I'll tell you how he does that. He buys a triple net lease. He can buy a medical building. He can buy a restaurant, something like that. He buys it for, let's say, a 7 cap, and he put $1 million down on that property. So he has to cover the rest of his sale price, and he takes out a big loan. So he actually goes above that sale price. So he's got out on a loan of $3 million at 4% for 3 years, interest only, something like that. And he's kind of playing that real estate game right now, something very low maintenance for him. That's why he's in a triple net lease. And then he bought $500,000 in oil and gas royalties at a 15 cap. And so his cash flow is $200,000 from the triple net lease. That is exchangeable, refi in the future, whatever. So that he's still kind of playing with that. He gets $75,000 annually from his oil and gas. He decides he wants to turn those into a family trust and pass those on to his kids, which is great. He can do that. And then what about this single family residence that he bought? Well, maybe he got his CPA to say that it was an income property and they reported low, no, somewhat small income on the property. But he decided, hey, I'm going to tell the IRS this is my primary residence now after holding it for 2 years. So kind of change his title from Bob Industries, grants it to himself. And now he owns a house free and clear. It's not considered an income property anymore, but the IRS is going to be like, no, that's fine. And now he's successfully deferred all of his taxes from selling his farm, and he's got cash flow.
Wow.
Cool stuff. He identified 3 properties. He knew the 3 things he was going to do, made it happen, deferred all those taxes, made sure all of that stuff was going 100% back into his pocket via cash flow. And this is a lot. I see this a lot. It's a lot of retirees, people who are, hey, I've owned this building for a while. I'm retiring. I want something low maintenance. And this is what they want to do. You know, it's a lot of it's the depreciation, right? They got to pay depreciation recapture. Yikes. No thanks. So this is kind of something they can do. All right. I just had this is kind of based on a real scenario, but the names have been changed. Someone sold a duplex in California for $600,000. And they bought 4 single family homes in Oklahoma. So because they identified 4, they had to close on all of them. The prices couldn't be that much higher than what they sold for, but they had a huge chunk of equity in their duplex. So they were like, well, darn, we're just gonna make sure and buy these all cash. So they could have refinanced all those properties down to 20%, pulled out a certain amount of cash. They could have leveraged them from the very beginning, you know, and bought a ton more houses if they wanted to. But instead, they just wanted to cash flow them 100%, and then later convert, you know, something into a primary residence for themselves because they were moving. So they were getting ready to leave California. They were going back to family in Oklahoma. So they deferred well over $100,000 in taxes easily just by holding that duplex for a couple years. They grew their portfolio. You know, they had things to play with. They could have exchanged out of those properties at a later date too, you know, but they were getting cash flow and now they're closer to family. So they met all of their goals that way. And because they didn't purchase too much property or the value of too much property, they hit their 295 rule that we talked about earlier. So that's something easily done. Here's where we get really complicated. So this is kind of, you can actually double end an exchange, right? So if I know that I want to buy an apartment building and I've got some single family residences all over, Dave, for example, he's got 10 single family residences in multiple states and locations. He was playing the single family home game for a while, and he sells and closes on 5 of those within the 45-day limit. The 45-day limit is not only for identification, but it's also for consolidation. So if I want to have one exchange, I'm using one exchange and all the money from that and putting it into one kind of pool, I can do that, and it's actually a lower fee too, but I can do that as long as I sell those properties within the 45-day limit. But I also have to identify within the 45-day limit. So how that works is as soon as I close on my first property, that 45-day timer starts ticking. So I, in essence, want to have those other properties stacked up, ready to sell in escrow or something like that if I want to add them onto my one exchange. So you make sure to tell your broker, tell your escrow officer, hey, we need to delay some stuff because, you know, my other property, you know, maybe this buyer fell out of escrow or something like that. So you can delay a lot of things in escrow and add to your time, although your official timer with the IRS only starts after the close of the first property. So that's a little tip for you guys when you're doing exchanges. Like if you need to delay it in escrow. I can't give you a delay. Right? I have to follow the IRS rules. So 5 properties sold within the 45-day limit. So that's one exchange. Well, they found a big property and they knew that they could sell the rest of their properties and get into that 50-unit complex with those exchange funds. So what they did is they said, all right, so we're going to identify this property. We're going to put 5 of our places into that Nathan, I need you to come and hold title on the other side of it for a while and give us 180 days to sell our other 5 properties. So we hold title for them on the other side. They take 5, they actually sell the other 5 properties in 90 days. So they reverse exchange all those into that one property. We pull ourselves out of title. They have one apartment building that they just forward and reversed 10 single family residences into one building with. Can you do it? Does it get ugly? Is this a long conversation with legal and myself and me holding your hand walking through it? Yes. It is very ugly. It's much easier to just try to consolidate them all up front if you could, sell as a portfolio, for example. But it's definitely possible. Okay, just so you guys know that. And then finally, kind of like a syndicated deal via TIC. Jen sells a triplex, $850,000. She's got $500,000 equity, $350 in debt. She partners with a syndicator to get in on their deal. And since she's bringing in 25% of a $2 million raise, they're like, heck yeah, we're going to give you that. But they need to give her a lower percent, because they can't just say like, oh, you're a 25% owner. They need to give her a lower percent of undivided interest in the TIC because of the purchase price of the deal. You need to base it off the purchase price, not just the amount raised. So the syndicator accounts for the other 82.5%. Jen signs on the loan because her debt has to be accounted for. So that's fine with her. She's like, hey, I wanted to get my name on some agency debt anyway. But the syndicator runs everything normally. And Jen actually has to be treated as a limited partner in this case. She can't be like, oh, and I'm going to be the asset manager too. Like that, it doesn't work that way. She needs to be kind of treated as a limited partner because otherwise the IRS may say, oh, you guys are being treated as a de facto partnership and that really wasn't an exchange. And I won't get into all the headaches of it, but just treat them as a limited partner, update them and pay them their checks and keep them updated, but don't let them do any asset management or anything, right? The syndicator sells for $8 million. Jen exits with them, but since she was on title, she can exchange again and she can go her separate way if she wants to. She can stay with them as they exchange to another property if that's what they're going to do. But she decided she wants to go her own way, and now she's got enough equity that she can buy her own building and she's ready to do it. So because she's on title, she's free to exit and exchange again, and she can keep deferring those taxes and growing her own portfolio. So that's what she does. And the syndication can do an exchange as well because the entire syndication holds title. The only difference is that they have to get all the limited partners to agree to do that. So if they don't all agree, oh, darn, you can't do an exchange, but you could offer them up some cash and buy their shares for what maybe they could earn. You could also ask them, hey, why don't you just exchange with us and then we'll refi, when we put the financing in, we'll be able to, buy you out or something like that. There's some creative things you can do with the financing part, but if you're running a syndication, you need to get all the limited partners to mutually agree to do an exchange. Everybody has to agree to do an exchange. All right. So just so you know that. And now we are here for all your questions. This is my contact information down below. You guys can use that, contact me anytime you have any questions, want to do a 1031, maybe you have someone who wants to do a 1031, you need, hey, maybe I could use some quick advice on this syndication that I'm running. Just email me, give me a call, text me. I'm pretty easygoing in that sense. More than happy to help you guys.
I do have a question, Nathan.
To some questions, go ahead.
Yeah, now you said that you're licensed in California. Can you do exchanges outside of California? How does that work?
Yeah, great question. So like I said, this is an IRS tax code. So, and we are fintech, we're financial technology. So everything that we do is run by our system. And I just kind of manage the system and the people. That's all I am, really. So I have people who sell in, it doesn't matter where, but I can handle their exchange. I just get in contact with their escrow officer. So when I say full service from start to end, hey, I want to do an exchange. I send you the documentation. We get digital signatures on everything. I'm not going to mail you a packet and ask you to FedEx it back to me by the 45th day, and you got to pay next day shipping and all that. Everything is timestamped digitally. And then you can call me on the phone. You can email me, hey, this is what I want to do with my funds. You can go to another state with it. I talk to your escrow officer over there, and we get everything set up correctly on the paperwork side. And I just make it as easy as possible for you. So you don't have, just because I'm licensed in California, I'm a licensed real estate agent. I'm not, you know, a licensed qualified intermediary. That is a national service that we provide. So I don't, just because I'm here in California means I can handle exchanges anywhere.
Thank you.
I have a few questions. First of all, thank you. It's very, very informative.
Welcome.
Depreciation, my understanding, I don't know if this is true, but my understanding was that depreciation after an exchange can't like start over. Is that true? Or does, like, once you've done your exchange and you start with the new property, you start over with your new depreciation just based on the value of that new property?
Yeah, your depreciation starts over, yeah.
Okay, okay.
It's based on the property. It's based on the property, not based on your exchange. Now the recapture got deferred from your first property. So the recapture got deferred. Well, you go into the next property and you're going to depreciate it, right? And that recapture is going to follow you too if you exchange again. So those things are all going to follow you, which is why I say, you know, hey, if you want to pay a huge chunk in taxes, basically when you sell that property and you sell it and don't exchange, the IRS is going to look back at everything you did and say, pay up. And you're going to write a big fat check.
Jeez.
So once you start, you really just got to keep going.
Yeah, you just keep going. But like, I think you guys know that, you know, you're buying based on, you know, hey, I want to buy the right property. I want to buy for my investors the right way. You know, we're doing our cost segregation. We're doing all the right things. And the people who understand and want to defer those taxes, I mean, go for it. It's an awesome way to really jump and double, triple the size of your portfolio over time that you don't get anywhere else.
You guys do cost segs too?
I do not do cost segregation studies, no.
Okay.
We'll be getting somebody to do that, Nate, to come talk to us. So that's heading up in the next few weeks.
So one other question that might not necessarily be as related to, but it's more related to your service as a qualified intermediary is, would you be a good person to talk to find off-market deals, presuming that all of your clients are trying to sell their properties?
So one good question. So because I'm in the multifamily world, I approach brokers as a qualified intermediary actually. And I say, hey, you know, I've got a client who's coming up on their 45-day time limit and they really need a property. And, you know, they really need something that's off market because they don't need to be battling some other guy on an offer. They really need to make sure that they're identifying the right thing. Do you have any off-market deals that I can send to them? And if they like it, I'll have them contact you. So,
I think what Alejandro was saying is that you have off-market deals that you may be able to share within a 45-day time frame with us.
So,
deal finding.
we have a property in Tulsa, 155 units that we're closing on in about 50 days. So I'm kind of like the 1031 advisor for these guys. I have some clients who are interested, some clients who are not mine who are interested, but all I can do is pretty much just help you as a syndicator and present those to who might be interested and help them understand their exchange, whether they're my client or not. I'm more than happy to just like, hey, here's the information you need to know on your identification, for example. So I am actually going to be doing a webinar on that property next week, Thursday. So if you guys are interested in hearing more about that, you want to jump in on that webinar and just kind of see what that looks like, email me and I'll make sure to send you an invite if you're that interested.
Yeah,
but it's not off market, obviously. But it's I get access to some things sometimes.
All right, thank you. Yeah.
So I have a small idea of how the reverse works, but can you just go through that just one more time as far as like how that works? Would I have to identify the property that's going to be purchased in advance and then sell, or does it happen like simultaneously, like somewhat like a double closing where I sell and then just the money just transfers over to the?
That's considered like a simultaneous exchange.
Okay.
You know, so no, a reverse exchange is literally like you know, especially in the apartment world. The reason that the 1031 exchange is so good in the apartment world is you have time. You know, it takes time to close. It can take 120 days to close a property sometimes.
Right.
Just all your due diligence. Maybe there's a renegotiation that takes place, but the forced appreciation that you can put into an apartment building is second to none. You're not going to get that in a triple net lease, not the same way, not in the same time frame. That's why the apartment world is so powerful. But it's also you have those delays as well. So in the apartment world, you would say, hey, I found this screaming deal, but I need to sell my last syndication, you know, down the road here. And, you know, I got to talk to all my investors and get them all on board to get the sale, get it over to a broker, get it advertised, get it out there. And I got to close on that one too. So you want to put this one under contract. So you put the one that you're buying under contract and you're going to buy it, right? Your syndication is, but you need to sell this one back here. And both of those are going to take a long time. So you can make the property that you're buying take as long as you need to, but you're getting down to the end of the wire and you need to buy it. But you've gotten the go-ahead from all your investors on your last syndication deal. They're ready to buy. It's already being advertised. You just need to sell it. So you're like, all right, Nate, we need to put an exchange accommodating title holder in place. Hold this property while we sell this one. Hey, this looks like a good idea. You know, I definitely think that you guys can get the money you need to exchange into this property. So we'll come in, we'll hold the property for you because you can't own the title. Your syndication can't own the title and then exchange into property you already own. That's not an exchange. You're not exchanging anything. You can't exchange it yourself. So that's how the IRS looks at it. So that's the only reason we have to come in. We have to come in on title for you and hold it while you know, and we have money backing us, so we can make sure and get on title for you. That's not a big deal.
So you'd be purchasing the property for me until I can sell my current property.
That's basically what it looks like.
Right, and that time frame is for how long?
So as soon as we close on the property that you're buying, 180 days to sell this one.
That's when the clock starts ticking. As soon as you close on that identified asset, then I got 180 days to sell this and get the money over to
get that money back into there and get us out. Yep.
Okay. And is there any, what kind of, are there any fees involved for you actually tying it up for me, or?
Thousands of dollars.
Yeah. Thousands of dollars?
Thousands of dollars. Depends on the size of the property. Like, it's consultation only. It depends on the size of the property, the level of difficulty involved. So that scenario where the guy was selling, you know, like 10 properties into one, that was a real scenario that they needed. And because of the complications of it's in different states, one's a duplex, one's a single family, they're all in different states. You got one property you want to buy. It's kind of like, well, and then how much money is it? And then what is the complications of it? And it's going to be $7,000-$10,000, something like that.
Okay.
Versus $750 for a forward exchange. You know, makes a big deal to some people, but I always just tell people, look at your taxes.
Yeah, I mean, I think it's the opportunity cost that you have to look at, because if it's a hot deal, you want to tie it up, and if it costs you a couple of grand to do that, then, you know, it's always ways you can make that up some other kind of way later on down the line, I'm assuming. But what I'm surprised to find out, I thought the exchange has to be exactly with a like-kind property. So
what is like-kind?
I mean, I guess it's ambiguous based on your definition. It could be.
Does it have title? Does it have investment or productive use?
Yeah.
It's not pretty much exchangeable. So, I mean,
I thought it had to be
the most like kind? The most like kind is like, I've got a single family resident, but I'm still renting it out, and I'm going to buy property that I'm going to rent out to someone else.
Right. I thought it was
The least like kind is probably like you selling anything and going into oil and gas, because it's like, well, it's real property, but it's mineral rights and it's based on production run by another company, or how does that happen? And that happens all the time. There's never been any IRS hookups.
all right. I mean, I was all this time, I was under the impression it was apples to apples, not fruit.
And go back to the 3 T's, right? Can you report taxes on both as income? Yes.
Yeah.
Right? Are you taking title the same way? Yes. Have you held it for a certain amount of time as investment or productive use? Yes. Good to go.
Yeah. Wow, I didn't know that. I thought it had to be apples to apples. That's good.
Happy to educate. That's what I'm here for.
I have one other question. So the idea of these TICs, these tenancy in common, is kind of new to me as a combination with the syndication. And what you said about how you treat them just as any other limited partner, what's the difference then between a tenancy in common and a syndication? Why wouldn't we just all do tenancy in commons, raise our money, and then everyone can do whatever they want in 1031 exchange until we die? And then that's it.
It's got to be ownership, right?
I think, so the benefit is you have ownership, like actual ownership of a piece of real estate. It doesn't mean like an apartment syndication. Doesn't mean that I own apartments 1, 2, and 3, 4, and 5, but you own a percentage of the entire property. That isn't necessarily drawn out. So there's a lot of rules to cover with a TIC. I didn't come here to just talk about a TIC today. If you guys want to cover those, like I said, webinar next week, Thursday, send me an email, say, hey, I want to know more about this stuff. How can I use it into what I'm doing? We can talk about those, because there's some rules that come into place, and it gets sticky, it gets hairy. Are they done all the time? But I don't know if you've heard this, like some syndicators will only allow someone to come in with an exchange if they're bringing in like $500,000. Because if I'm raising $2 million for something, and I got someone coming in with like $200,000, that's a pain to give somebody like what percent of that, 5%, 4.5%, how much is it for that? Whereas if you got, and then you've got to set up that whole structure alongside your 506, and put all that headache together. It's not fun, but if you've got multiple people interested and you might even get fully funded off of 1031s, then yeah, a TIC is definitely required, but that has its own set of rules that everybody's kind of got to abide by. And it's got to be kind of outside the 506 structure. Like we can get the SEC attorneys on here too, and we can talk about how complicated they get, but there's benefits and detriments to both.
Nathan, would you be able to provide the webinar or podcast information, and we could invite some folks from the Zoom, from the Slack channel? Would that be something you would be open to?
Absolutely.
Okay, let's do that, because I think there's enough interest, especially from the 3 of us, 5 of us, that we could maybe generate some interest from the rest of the people to do that for next week. Is it this week? Is it this Thursday, or is it next Thursday?
Next Thursday. So you got a week.
Yeah, I would be interested to know. So if you could forward that information, I'll put it on the Slack channel, and we'll see if we can get some other folks.
Yeah, absolutely. So I will. I'll get you guys a link set up, and we'll do that.
Great.
My pleasure.
Does anybody else? I know we're over time here. Does anybody else have any information or questions or concerns?
I have one quick question so on the front end of getting the syndicated deal with investors. So if I got 5 investors and one is on the front end saying they're older or whatever, so they're probably not going to do a 1031 exchange on the deal, that we have to, so does their money go in like a separate escrow, or how does that work on the front end? If you got 5 investors?
You cannot break up. So going back to the 3 T's and title, right? So even though Syndication LLC is holding title, right? the structure of that LLC has changed if so-and-so doesn't want to do an exchange. They want out. So I can't, the only thing that I can do is buy them out and become and take their shares so I get their vote and then do the exchange, because I can't change the structure of my LLC in terms of like who has what shares, what's going where. I want to split it up or split it up in an exchange. I can't do that. So once you're in an exchange, nothing changes. So it either has to happen, you buy them out, you change things up a little bit before you sell, or they're along for the 1031 ride. And then when you close on the other property, you get your financing in place. Maybe you get an acquisition fee and you buy them out personally or something like that.
Okay, so it's probably easiest to try to find investors that are all interested in doing the same thing of maybe a 1031 exchange. Okay.
Absolutely. And especially if they've got something like they're investing with you via Roth, where, they want to take as big a bump as possible because it's going to be tax-free for them anyway, because they're investing via Roth. Then that's definitely added advantage too. I mean, it's just exactly, you got to find people who have the same idea. I want to be growing as fast as possible. I'm not, whether we defer them through a 1031 or I'm all Roth, so I don't even care. Let's just get bigger faster. There's definitely a space for that. So, get a few people together that maybe want to start in the 50 unit range, where you can really turn a property around in a couple years. Yeah, it's definitely a way to force appreciation, sell, exchange, buy another one, buy another two, and keep going.
Wow, that's amazing. Nathan, you brought so many good ideas and thoughts for all of us. I really appreciate it.
I got
My pleasure.
What's that?
I got one last question, just to make sure I'm clear. And I'm going to contact you too, Nathan.
Hit me, Nate. Hit me.
But did you say you could double the amount of spend? Because I thought you said on one of those scenarios, just to make sure I'm clear, that it would be like if I had a sale for $2 million, I could buy up to $2 million worth of real estate.
Okay.
You have to.
So if I'm selling for $2 million, even if my equity is like 500,000, right?
Mm-hmm.
I need to take that 200,000. So what goes to me is only your equity.
Right.
But I look at your sale price for what you sold.
All right. It's the sale
$2 million.
Right.
Because that's what the IRS looks at.
Right.
Your purchase price needs to be $2 million or more.
Right.
Now, if you had 100% equity and you literally had $2 million in cash, which is, if you're getting any appreciation out of that, you bought it for $1 million, you're selling it for $2 million, you're probably going to have $1 million and some change in equity, right? You got at least $1 million through appreciation. You got your original equity, what you bought for. So you're probably looking at $1.5 million after principal, right? $1.5 million. Take that and leverage it to the tilt, as much as you can.
Right.
Even if you want to be conservative, you're still looking to buy, 50% loan to value. You're still looking to buy $3 million worth of real estate. So that's a good bump too. You're selling for $2 million and buying for $3 million. That's how this normally works. That's what a 1031 does best.
Yeah, I got to call you, man. I got to call you tomorrow.
I'm so glad.
I spoke to someone in Madison 1031, if you're familiar with that company. And I'm
only familiar with me, bro. I'm sorry.
Oh, okay, no problem. But it wasn't as informative as you've been. So I think you might be my guy now. It's like
my biggest selling point, like my background's in computer science and math, and this is where, like I said, we're a fintech company. I'm not going to push papers. I'm going to handle your exchange electronically. Your qualified intermediary is called EMP LLC, which is Exchange Manager Pro. It's our software, right? I'm the connection piece between you and them, you and the QI. I am a QI, like I'm a team, right? But we are a software piece. So everything we do is electronic. I don't know any other exchange accommodator who's doing this. I'd tell you about them if I knew, but most people I know, they are going to send you a packet. They're going to say, I need a wet signature and I need you to FedEx it back to me. Right. Or you got to come to my office. So if you're buying real estate all over the United States, that can be a real pain, right? Whereas I can handle everything. Like you just, hey, here's these documents, sign it. You told me what you wanted to identify. I'll type it in for you, send it over. You get it signed. We get it into our system. You're good to go. You schedule when you need your funds dispersed. And we take care of all the account stuff with your escrow officer, whoever's handling that. Done.
Now, do you guys also as QIs, do you have a department or a component that handles the IRAs, the self-directed IRAs? So if I have investors that want to, participate in that from that kind of standpoint, do you guys handle that as custodians?
I've got contacts for that. I got a contact for that, but I'm sure other people do too. So you can reach out to me. I'll send you somebody, but I don't have oh, this is us. No. But I can refer you to a couple other people.
Yeah, I've got somebody. I just
Nate, I gotta cut you
Oh,
off,
okay.
Nate.
All right, I'll call you.
So we're over. I told you at 6 we got to get out. So you've been so wonderful, Nathan, to give us more of your time. We all really appreciate it. It's been super informative. So
definitely.
Make sure you got his number. If you are talking to any of your clients, make sure you contact Nate. Have him get a hold of Nathan and utilize the 1031. It's an amazing product and service. So thank you guys. I'll see you next week.
Thank you for your time.
Remember,
Thank you, Julie.
Thanks, Nathan.
so people you care. Thank you.
Thank you.
Bye-bye.
See you guys.
Good evening, guys.